What if the United States is already in a recession, but no one wants to say it out loud? What if the economy isn't about to slow down? It's been slowing for months and you just haven't seen it yet. This isn't just speculation. This is a pattern. One we've seen before, and one we're about to see again, just with a different name. Welcome to a journey through the numbers they don't put in the headlines, the shifts they bury behind technical definitions, and the reality that millions of Americans are already feeling in their wallets. 0. The Invisible Recession. Let's start with a basic question. What is a recession? You might think it means the economy is collapsing. But in economic terms, it's simply 2 quarters of negative GDP growth. That's it. No stock market crash required. No mass panic. Just contraction. But here's the twist. In the United States, a recession isn't officially declared by the government. It's defined retroactively by a small committee of economists from the National Bureau of Economic Research, or NBER. And they can wait months, even a year, before saying the R word. So by the time they admit it, you're already living in it. 1:30. What history tells us. To understand where we're going, let's look at where we've been. In 2008, the Great Recession had already begun by December 2007. But the declaration didn't come until December 2008, a full year later. The dot-com crash? Same story. The recession began in March 2001. The call came November. And that delay? It's not harmless. It changes how fast the public reacts, how policy is shaped, and how prepared you are when the next wave hits. Now let's zoom in on today. We've had a post-COVID boom, unemployment near historic lows, markets rebounding, inflation cooling a little, but beneath that surface, there are cracks, some obvious, some invisible unless you know where to look. 4-0 why 2025 could be the breaking point. We're not predicting doom. We're reading signals, and right now, the signals are everywhere. You just have to know which ones matter. Let's walk through them. The U.S. economy, as of early 2025, is slowing. GDP growth projections are being revised down quarter after quarter. Corporate profits, down. Job openings, drying up. Wages, stalling. But here's what few are talking about. Real disposable income, what's left after taxes and inflation, has been declining for over a year. Credit card delinquencies have surged to 2009 levels. Auto loan defaults, rising for 7 straight quarters. Small businesses are shutting down faster than new ones are opening. These aren't headlines, these are symptoms of a system slowing beneath the noise. 7:30 quiet indicators everyone misses. Let's talk about the whispers in the economy, the ones too quiet for mainstream media to chase. First, the yield curve. When short-term interest rates are higher than long-term rates, that's a red flag. It means investors believe a slowdown is coming. And guess what? The U.S. yield curve has been inverted longer than at any point since the 1980s. Every time it stays inverted for this long, a recession follows. Then there's the leading economic index published by the Conference Board. It's designed to predict turning points in the economy, and it's been falling for over 12 months straight. That has never happened outside of a recession. 10-0. What people are actually feeling. You can ignore forecasts. You can debate technical definitions. But you can't ignore what's happening in people's lives. Food prices are still high. Rent, keeps rising. Utility bills are up, savings accounts are shrinking, and people are turning to credit cards not for luxuries, but to buy groceries. Consumer sentiment surveys from the University of Michigan show a dramatic fall in confidence even as Wall Street cheers every small gain. What does that tell us? That the average American doesn't feel the recovery, because, in real terms, for many of them, it hasn't arrived. 13. Zero corporate behavior. The canary in the coal mine. If you want to know where the economy is heading, don't just watch consumers, watch corporations, because they move first quietly before the public ever feels the shock. And right now, big companies are sending warning flares. Mass layoffs at tech giants like Amazon, Google, and Meta. But it's not just tech anymore. Retailers are trimming staff, logistics companies are cutting routes, manufacturers are scaling back production orders. And notice the pattern. Even profitable companies are slashing jobs. Why? Because they see what's coming and they're preparing to survive it. Another sign? Corporate cash holdings are growing. Businesses are hoarding cash rather than investing in growth. When companies stop betting on the future, it means they're bracing for a storm. 16. Zero Wall Street versus Main Street. Turn on the news and you'll see record highs on the stock market, a booming NASDAQ. Optimism. But if you dig deeper, you'll find something strange. The rally isn't broad. It's concentrated in a handful of mega-cap tech stocks. Strip out the top 5 companies and the market looks flat, or worse, in decline. This divergence between Wall Street and Main Street is dangerous. It creates an illusion of strength, while beneath the surface, the real economy is bleeding. And historically, when this gap becomes too wide, reality crashes back with a vengeance. Remember 2000, the dot-com bubble? High-flying stocks didn't save the economy then, and they won't save it now. 20. Zero domino effects. Already in motion, economic slowdowns aren't sudden events. They're slow-motion chain reactions, and several dominoes are already tipping. The labor market is weakening. The number of part-time workers who want full-time jobs is rising sharply. Quiet layoffs and hiring freezes are everywhere, even if unemployment numbers look deceptively stable. The housing market is cracking. Mortgage rates spiked above 7% in 2024 and remain stubbornly high. Home sales are down. Prices are softening in key cities. Consumer debt is exploding. Americans now owe a record $1.13 trillion on credit cards with average interest rates above 20%. This isn't just noise, it's a clear pattern. The consumer, the backbone of the U.S. economy, is under serious strain. 23. Zero hidden government moves. While the public watches inflation numbers and gas prices, Washington is making moves behind the scenes. Federal spending growth has slowed dramatically. Stimulus programs have ended. Student loan repayments have resumed. In essence, the safety nets are being pulled away right as people need them most, and what's replacing them? Higher taxes, tighter budgets, reduced services, all of which will quietly drag on economic growth whether anyone wants to admit it or not. 27. Zero. The Fed's dangerous game. The Federal Reserve faces an impossible dilemma. If they keep interest rates high, they risk crushing economic growth and triggering a full-blown recession. If they cut rates too early, they risk reigniting inflation and losing all credibility. So what's happening? The Fed is trying to walk a razor's edge, signaling maybe future cuts while keeping financial conditions tight. But history shows the Fed almost never engineers a soft landing. More often, it hikes rates until something breaks. And when it breaks fast. 30. Zero. The soft landing myth. You'll hear it everywhere. This time is different. The Fed can achieve a soft landing. But let's be brutally honest. Soft landings are extremely rare. In the last 60 years, there have been only two clear examples, 1966 and 1994. Every other major hiking cycle? It ended in recession. The odds are not in favor of a smooth glide path. They're in favor of turbulence, real turbulence. 34. Zero stocks are lying to you. Many people believe the stock market is a forward-looking indicator, that rising stock prices mean a healthy economy tomorrow. But that's a half-truth. Stocks are driven by liquidity, not reality. If there's cheap money, stocks rise. If money dries up, stocks fall. And right now, even with modest optimism on Wall Street, liquidity is draining fast. Corporate earnings are under pressure. Margins are shrinking. Debt is getting more expensive. Yet the market floats higher for now like a balloon ignoring the wind. History shows when reality and markets diverge this far, reality eventually wins. 37. Zero. The real risks in 2025. If you think the only risk is higher prices or slower growth, think again. The real dangers in 2025 are bigger, deeper, and harder to reverse. Let's break them down. Geopolitical tensions. The US-China relationship is worse than at any time in the last 40 years. Taiwan remains a flashpoint. New trade wars could easily erupt, choking global supply chains and pushing inflation back up. Energy shocks. Oil markets are fragile. One major disruption, whether from the Middle East, Russia, or elsewhere, could send energy prices soaring again. Debt time bombs. The US national debt surpassed $34 trillion. Interest payments alone are approaching $1 trillion per year. This isn't just a number on a screen. It limits what the government can do when the next crisis hits. Political paralysis. 2025 is shaping up to be one of the most divisive election cycles in American history. Gridlock isn't just likely, it's almost guaranteed, meaning no swift action when the economy needs it most. Each of these risks alone would be serious. Together, they form a storm most Americans aren't prepared for. 40. Zero. Silent recession versus declared recession. There's a growing idea among economists that America could experience a silent recession. What does that mean? It means an economy that technically grows but feels like it's shrinking. Real wages decline after inflation, employment stays high, but quality jobs disappear, debt burdens rise quietly, corporate profits shrink. But official GDP remains flat or slightly positive. It's not an official recession, but it feels like one. To families, to small businesses, to young people trying to build their future. And because it's not declared, no one sounds the alarm. No stimulus checks, no emergency programs, just slow erosion. 45. Zero. Who benefits from hiding it? You might wonder, why wouldn't the government just admit it? Simple, because acknowledging a recession would trigger political chaos. Markets could panic. Consumer confidence would crater, and for those in power, politicians, central bankers, corporate executives, denial buys time. It keeps stock prices high. It keeps voters calm. It keeps business moving even if the ground is already cracking underneath. In short, there are powerful incentives to delay, deflect, and distract. To tell you things are strong, even when your wallet says otherwise. 50. Zero. How to prepare now. If we are indeed standing at the edge of a silent recession, or worse, what can you do? Here are the moves smart people are already making. Build cash reserves. Liquidity is king in downturns. Emergency funds aren't optional, they're survival tools. Cut high-interest debt. Carrying balances on credit cards at 20%. Jiaong. Interest is financial suicide during economic contractions. Diversify income. Relying on a single paycheck is a risk. Side hustles, remote work, freelance skills all add resilience. Stay light and mobile. Big financial commitments, luxury purchases, new mortgages, new cars are dangerous when uncertainty rises. Invest cautiously. This is not the time for blind risk-taking. Preservation matters more than chasing big gains. Stay informed. Economic storms punish the uninformed the most. Pay attention not to headlines but to real indicators. 58. Zero final thoughts. Thinking for yourself, the reality is simple. By the time experts tell you a recession has arrived, it's already too late. Economic shifts don't announce themselves with sirens. They creep in through the back door. They hollow out communities. They squeeze families. They chip away at your future, one quiet month at a time. Stay skeptical. Stay ready. Because in 2025, those who wait for permission to act may find themselves too late to act at all. Thank you for watching. Hit subscribe, because understanding the future starts with seeing the present clearly. And together, we'll navigate what's coming, eyes wide open. Deeper dive. How recessions are hidden in plain sight. Most people imagine recessions as sudden dramatic collapses, headlines screaming, markets in freefall, chaos everywhere. But history tells a different story. Recessions often begin quietly. Job postings shrink before layoffs are announced. Wages stagnate before unemployment spikes. Small businesses close their doors before bankruptcy rates explode. It's a slow fade, not a sharp break. And in 2025, that slow fade is already happening. The danger of lagging indicators. One of the biggest traps for the average person is relying on lagging indicators, official unemployment rates, GDP numbers, earnings reports. All these metrics tell you where the economy was, not where it's going. By the time unemployment rises, the damage is done. By the time GDP turns negative, businesses have already failed. By the time earnings crash, your investments are already bleeding. If you want to survive and thrive, you need to read leading indicators, new job postings, small business sentiment surveys, transportation volumes, credit card delinquency rates. And right now, those indicators are flashing bright red. Signs from the job market. At first glance, the labor market seems strong. Unemployment is low. Job growth continues. But under the surface, the majority of new jobs are part-time or low-wage service positions. Layoffs in tech, finance, and manufacturing are increasing. Hiring freezes are becoming the norm in mid-sized and large companies. The quality of jobs is deteriorating even if the quantity looks stable. And when that happens, consumer spending, the lifeblood of the US economy, inevitably weakens. The consumer is running out of steam. For years, American consumers kept the economy afloat through stimulus checks, rising home values, and booming stock portfolios. But those pillars are crumbling. Stimulus money is gone. Home prices are stagnant or falling in key markets. Stock market gains are concentrated in a handful of companies, not widespread. Meanwhile, savings rates have collapsed. Credit card balances are at record highs. Delinquencies on car loans and credit cards are surging. Simply put, the consumer engine is sputtering. And when the consumer stalls, the economy soon follows. Hidden cracks in the housing market. You might hear that the housing market is strong, but the reality is more complicated. Yes, Inventory remains low, keeping prices from crashing. But transactions have plummeted. Mortgage applications have fallen to multi-decade lows. First-time homebuyers are priced out, and now a new threat looms. Adjustable-rate mortgages, ARMs originated during the post-pandemic boom, are beginning to reset, meaning higher payments for millions of homeowners. Foreclosures are still rare. But watch closely, because rising delinquencies could be the next domino to fall. Small business pain points. Small businesses account for nearly half of private sector employment in America, and they're hurting. Access to credit has tightened dramatically. Input costs, wages, materials, energy remain high. Consumer demand is softening. Many small business owners are operating month to month. One bad quarter could mean closing their doors for good. And when small businesses fail, local economies collapse, job losses spike, communities hollow out. It's a quiet crisis, but a devastating one. The student loan squeeze another hidden pressure point in 2025. The resumption of student loan repayments. For nearly 3 years, millions of Americans didn't have to pay back their loans. Now, that monthly burden is back, and it's squeezing budgets that were already stretched thin. Early data shows a sharp drop in discretionary spending among borrowers. Restaurants, retail, travel, all feeling the pinch. This matters because consumer spending drives 70% of US GDP. A cutback here, even if it's subtle, can ripple through the entire economy. The wealth effect is fading for years. Americans felt richer because of rising home values and soaring stock markets. This wealth effect made people spend more freely, even if their actual incomes didn't grow much. But in 2025, that effect is breaking down. Home values have plateaued, and in some regions, they're declining. Stock market gains are concentrated among a few tech giants, not broad-based. Rising interest rates mean lower valuations for future earnings. When people feel poorer, even if their paycheck stays the same, they spend less. And that slowdown, though invisible at first, gradually builds into full-blown contraction. The rise of shrinkflation and consumer backlash. Another subtle but powerful trend in 2025. Consumers are angry and adjusting their behavior. It's not just about higher prices anymore. It's about getting less for the same price. Smaller packages, lower quality, fewer services. This shrinkflation erodes trust. People cut back, not just because they can't afford more, but because they refuse to pay for less. Retailers are already reporting trade-down behavior. Shoppers switching from premium brands to cheaper alternatives, skipping non-essentials entirely. Once consumer habits shift downward, it's hard to reverse, and it creates a lasting drag on corporate revenues. The illusion of soft landing language. You'll hear phrases like moderating growth, orderly slowdown, normalizing demand. They're designed to calm you, to make stagnation sound like stability. But here's the truth. Soft landings are rare because human behavior isn't smooth. Fear is contagious. When people believe hard times are coming, even if data looks okay, they cut back sharply. Businesses react to falling sales by cutting jobs. Laid-off workers spend less. The cycle feeds on itself. Economic psychology matters more than spreadsheets. And right now, the psychological undercurrent is shifting toward fear. Transportation and shipping. Early warning systems. Want to know how the economy is really doing? Don't just watch Wall Street. Watch trucks, trains, and ships. In 2025, freight volumes are declining. Trucking companies are warning about excess capacity. Railroads are moving fewer goods. Shipping demand out of major ports is softening. Transportation moves before retail shelves empty, before layoffs, before earnings warnings, and the transportation sector is quietly flashing recession signals. Corporate earnings games public companies know the stakes. They know that missing earnings expectations tanks their stock price. So they're playing games, cutting costs aggressively to prop up profits, issuing vague future guidance, buying back shares instead of investing in growth. On the surface, earnings reports might look fine, but underneath, the foundation is weakening. And once it cracks fast. Real estate is a slow-burning fuse. The housing crash of 2008 was dramatic, but housing slowdowns can also be slow-motion disasters. In 2025, commercial real estate is under major pressure. Office vacancies are rising in major cities. Remote work is permanent for many industries. Property values are falling, but debt remains. Small regional banks heavily exposed to commercial loans are particularly vulnerable. And if enough of them falter, credit tightens, lending dries up, another domino falls. Residential real estate isn't immune either. High rates, GL1, stagnant wages equals affordability crisis, fewer buyers, more price cuts, longer time on market. It won't be a 2008 style crash. But a long, grinding decline is just as damaging, just slower. The return of survival mode. Thinking. During good times, people think about upgrades, experiences, and investments. During hard times, they think about survival. In 2025, we're seeing the return of saving over spending, fixing old things instead of buying new ones, cooking at home instead of dining out, delaying major life events, marriages, children, home purchases. This mindset shift isn't just personal. It becomes economic reality. When millions of people tighten their belts simultaneously, it slows growth across every sector. The silent corporate pullback. It's not just consumers shifting to survival mode. Corporations are too, but quietly. Instead of headline-grabbing layoffs, many companies are delaying new projects, freezing hiring without announcing it publicly, cutting marketing budgets, scaling back research and development. These quiet pullbacks rarely make news, but when they happen across thousands of companies simultaneously, they slow the economy invisibly at first, then obviously later. The bond market's grim warnings. Professional investors aren't looking at stock charts. They're looking at bonds. And the bond market is sending a clear and chilling message. Yield curve inversion has persisted for record duration. Credit spreads are widening, meaning lenders are demanding more compensation for risk. Corporate bond defaults are rising, especially in junk-rated companies. The last two times we saw this pattern, 2007 and 2000 recessions followed. Bonds rarely lie, and they're whispering warnings to anyone willing to listen. Government debt and the fiscal squeeze. At some point, government intervention might be necessary to counter economic slowdown. But there's a problem. The US government's debt load is so massive, $34 trillion, and counting, that its ability to stimulate is shrinking. Rising interest payments mean less room for new stimulus packages, higher pressure to raise taxes or cut spending elsewhere, less flexibility to respond to emergencies. In the next downturn, there will be no easy options, only painful choices. The election year wild card 2025 is a post-election year, but the effects of the 2024 election still ripple. Political polarization is at historic highs. Trust in institutions is low. Policy stability is fragile. Any major economic disruption could quickly spiral into political chaos, making coordinated responses nearly impossible. Markets hate uncertainty. And right now, America's political system is brimming with it. What happens when confidence breaks? Economic collapses don't happen just because of bad numbers. They happen when confidence breaks. Consumers stop spending, businesses stop investing, investors stop believing. And when confidence breaks, it moves fast. Markets that took years to climb can lose half their value in months. Strong companies cut payrolls overnight. Careers and savings built over decades can vanish in a blink. Confidence is the invisible glue holding the economy together, and it's starting to fray. What to watch going forward? No one knows the future. But here are the key signals to watch in the coming months. Initial unemployment claims a rise. Here is an early warning. Consumer credit delinquencies, especially auto loans and credit cards. Small business bankruptcy rates spike signal real stress. Freight volumes and shipping demand continued declines point to shrinking activity. Corporate earnings revisions, especially downward guidance for 2025. These aren't flashy headlines. They're the quiet currents beneath the surface, and they often tell the truth before the mainstream ever catches up. The two-track economy. 1. Final note. In 2025, we're seeing the emergence of a two-track economy. High-income households are still spending. Luxury goods, travel, and premium services remain strong, but middle-class and working-class Americans are struggling. Essentials, food, shelter, healthcare are consuming larger shares of budgets. Wealth inequality continues to grow. This divergence masks the severity of the slowdown, because while one part of the economy thrives, the foundation beneath it weakens, and eventually, the cracks spread upward. Why you must think independently. In an environment like this, waiting for official announcements is dangerous. The institutions that report on the economy, government agencies, media outlets, think tanks all have incentives to delay bad news. They want to avoid panic. They want to maintain stability. They want to protect elections, markets, and reputations. But you have to protect yourself. By the time they admit there's a problem, it will already be your problem. What past recessions teach us about preparation. Every recession is different. Different causes, different triggers, different effects. But one thing remains constant. Those who prepare early suffer less. Those who wait for permission to act suffer most. Look back at 2008. Those who reduced debt early avoided foreclosure. Those who kept emergency savings avoided bankruptcy. Those who diversified income streams weathered job losses. Preparation isn't panic, it's prudence. It's understanding that economic cycles are natural, but survival is optional. Personal resilience. Building your economic armor in uncertain times, resilience matters more than predictions. Here's how to build it. Emergency savings aim for 6-12 months of living expenses, not in stocks, not in risky assets, in cash or equivalents, safe and liquid. Debt discipline. Eliminate high-interest consumer debt aggressively. Debt magnifies vulnerability. Income flexibility. Explore secondary income streams. Skills in freelancing, consulting, digital work. These provide critical flexibility if traditional jobs vanish. Spending awareness. Track every dollar. Cut discretionary expenses before you're forced to. Mental toughness. Economic downturns are emotional. Anxiety rises. Fear spreads. Stay calm, rational, and focused on long-term plans. Community matters more than ever in downturns. Isolation is dangerous. Community is power. Build networks, professional communities, LinkedIn groups, industry forums, freelance collectives. Local communities, neighbors, family, friends. Online communities where ideas, jobs, and resources circulate fast. The lone wolf myth doesn't survive recessions. Those who adapt together survive together. Navigating investments in a pre-recession environment. If you have investments, 2025 demands caution and strategy. Diversify beyond stocks. Consider bonds, cash equivalents, and real assets like commodities or real estate selectively. Quality. Overhype. Focus on companies with strong balance sheets, positive cash flow, and essential products. Liquidity matters. Be able to access cash without selling at a loss. Ignore short-term noise. Markets will be volatile. Daily moves mean nothing. Focus on fundamentals. Be patient. Downturns create opportunities, but only for those who survive the downturn itself. Recession versus depression. Understanding the difference. Is 2025 setting up for another Great Depression? No, at least not yet. Depressions involve mass unemployment, 20%, multi-year GDP contractions, systemic banking failures. Recessions are sharp, painful slowdowns, but usually shorter in duration. However, prolonged stagflation, slow growth, jiaon, high inflation is a real risk for the 2020s if policy mistakes continue. That scenario would erode living standards slowly over years, less dramatic, but devastating in its own way. The opportunity hidden inside every recession, every crisis hides opportunity. New businesses are born. Fortunes are made buying when others panic. Innovations emerge to solve new problems. If you're prepared mentally, financially, emotionally, you won't just survive. You'll position yourself to thrive when recovery begins. The mistake is assuming opportunity appears without hardship. It doesn't. Opportunity is hidden inside hardship. You must walk through the storm to find it. Final warning. Don't wait for permission. The economy doesn't send you a letter saying, "Recession starting soon." It leaks, signals, it hints, it whispers. The media, the government, the experts, they will be the last to acknowledge the storm. Your job is to act before it becomes obvious, because when it's obvious to everyone, it's already too late to prepare. A new economic reality is emerging. The world is changing. The assumptions that held true for decades, cheap money, endless growth, stable geopolitics, are cracking. 2025 isn't just another economic cycle. It's the beginning of a new era, an era where inflation isn't transitory, it's structural. Global supply chains aren't reliable, they're fractured. Political polarization isn't temporary, it's entrenched. Financial markets aren't stable, they're distorted. You can't navigate this new world with old maps. Mindset shifts for the 2025 economy to thrive. You'll need a different mindset. From optimism to realism, hope is not a strategy. Prepare for difficulty, then be pleasantly surprised if it's easier. From consumption to production, those who create value goods, services, content, solutions will always have an edge. From dependency to independence, reliance on a single employer, a single income stream, or a single government program is dangerous. From herd mentality to independent thinking, if you follow the crowd, you'll always be too late. The future belongs to the adaptable, the resilient, the forward-looking. Closing, what they won't tell you. No one is coming to save you, not politicians, not central banks, not media pundits. And that's not bad news, it's empowering news, because it means your fate is largely in your hands. The signs of slowdown are everywhere. You've seen them now, you understand them. The only question left is, will you act early? Or will you wait for permission and find yourself reacting too late? The choice is yours. Prepare, adapt, stay sharp, and stay strong. Because history doesn't reward the complacent, it rewards the prepared. Thank you for joining this deep dive. If you found value here, hit subscribe, stay connected, and together let's navigate the future with open eyes and steady hands. The storm may be gathering, but with clarity, courage, and community we can weather it and even grow through it. See you in the next video.